$18,000, not hidden in a footnote, not buried in a contract nobody reads, not extracted through a scam or a fraud or anything that requires deception to execute. $18,000 per year, leaving the net worth of the average middle-class American household through a system that is entirely legal, entirely disclosed, and almost entirely invisible to the people paying it. My name is Emily. And 3 years ago, I was sitting across from my accountant in April watching him finalize my tax return. And I asked him a question I had never asked before. I asked him, how much total tax am I actually paying? Not my federal income tax rate, not my effective tax rate, the total, everything. Federal income tax, state income tax, FICE, Social Security, Medicare, property tax on my home, sales tax on everything I buy, the taxes embedded in my utility bills, the taxes my employer pays on my behalf that reduce what they can afford to pay me. He looked at me for a moment and said, "Nobody ever asked me that." Then he spent 20 minutes with a calculator. The number he came back with was 41% of my gross income. I earn a middle-class income. I am not in a high tax bracket. I do not live in the highest tax state. I am exactly the person the tax system is described as protecting, with progressive rates and standard deductions and all the language of fairness that surrounds American tax policy. 41% of my gross income was leaving my household through taxes and tax equivalent costs before I made a single personal financial decision. And then my accountant said something that made that number feel larger, not smaller. He said, and that number doesn't include the taxes you're paying that you never see because they're embedded in the prices of things you buy, or the tax advantages you're not capturing because nobody showed you how. I went home that evening and spent 3 hours with a spreadsheet. What I found was not that the tax system was cheating me. What I found was that I had been leaving a specific calculable amount of legal tax reduction on the table every single year. Not because I was irresponsible, not because I lacked access to the tools, but because the financial education system that is supposed to prepare middle-class Americans for this does not teach the actual mechanics of how income is taxed and how the tax code's built-in advantages are accessed. The $18,000 per year is not what I was paying in taxes. It is what I was overpaying. The difference between what someone with my income in my situation was legally required to pay and what someone with my income in my situation who understood the mechanics actually paid. $18,000 per year. For every year, I had been a working adult without this knowledge. This video is the thing I wish I had been given when I was 25. The exact mechanism behind how middle-class income is taxed in ways most people never fully see. The specific tax advantages that are available to anyone earning a middle-class income that most people do not use. And the 4 decisions that, in my own financial life, converted $18,000 per year from money flowing out of my household into money that stayed. But before the decisions, you need to understand the full picture of what is actually happening to your income. Because the tax conversation most people have, what bracket am I in, what do I owe in April, addresses less than half of the actual tax load that middle-class Americans carry. The visible tax, the invisible tax, and the tax you pay twice. The visible tax is the one everyone knows about. Federal income tax. You earn income. You pay a percentage based on your bracket. You file a return in April. For a household earning $75,000 in 2024, the federal income tax after the standard deduction is approximately $8,400. That is an effective federal rate of approximately 11.2%. 11.2% feels manageable, reasonable, the progressive system working as described. But federal income tax is not the only income tax that household pays. State income tax, for the 43 states that levy it, adds an average of approximately 4.5% for middle-income households. On $75,000, that is approximately $3,375. Total visible income tax, $11,775. An effective rate of 15.7%. Still feels manageable. Now the invisible taxes begin. FICA, the Federal Insurance Contributions Act tax, removes 7.65% from every dollar of earned income, up to the Social Security wage base. On $75,000 of wages, the employee pays $5,737 in FICA taxes. This number does not appear prominently on your tax return because it is withheld from every paycheck rather than calculated at filing. Most people know it exists. Almost nobody calculates it as part of their annual tax total when thinking about their overall rate. But it is a tax, $5,737 per year on a $75,000 income. Total visible and FICA taxes, $17,512, an effective combined rate of 23.3%. Now the employer side FICA. Your employer also pays 7.65% of your wages in FICA taxes, the employer match. This is a tax on your employment that you do not directly see because it is paid by your employer rather than withheld from your paycheck. But here is what the employer side FICA actually means in practice. Your employer's total cost of employing you is not your salary. It is your salary plus the employer FICA match, plus any benefits they provide, plus workers' compensation insurance, plus unemployment insurance contributions. Your employer decides what they can afford to spend on your total employment package. The taxes they pay on your employment are part of that package. Every dollar they pay in employer FICA is a dollar that cannot be paid to you in salary. A 2022 study by economists at the National Bureau of Economic Research, examining compensation across 45,000 employers, found that employer-paid payroll taxes are substantially passed through to employees in the form of lower wage growth, with the pass-through rate estimated at approximately 70 to 80% over a 5-year period. In practical terms, the employer FICA contribution on a $75,000 salary, approximately $5,737, represents money that is economically attributable to your labor, but is never paid to you. If you include the economic reality of employer FICA in the calculation, your effective payroll tax rate is closer to 14.7% rather than 7.65%, because both sides of the tax are economically borne by you, just differently structured. Total taxes, including employer-side FICA economics, approximately $23,249, an effective combined rate approaching 31%. We have not yet reached property tax, sales tax, or the taxes embedded in consumer prices. The average American homeowner pays property taxes equal to approximately 1.1% of their home's assessed value per year, for the median American home value of approximately $312,000 in 2024. That is approximately $3,432 per year. Property tax is not income-based. It does not scale with your tax bracket. It is a fixed percentage of asset value, meaning it hits middle-income homeowners proportionally harder than high-income homeowners for whom the same dollar amount represents a smaller share of total income. Total taxes now, approximately $26,681. Effective rate approaching 36%. Sales tax in the United States averages approximately 6.6% across states that levy it. A household spending $47,000 on goods and services subject to sales tax, approximately the average American household consumption figure, pays approximately $3,102 per year in state and local sales taxes. But sales tax is not the only consumption-side tax embedded in prices. Federal and state excise taxes are embedded in the price of gasoline, alcohol, tobacco, and numerous other goods. A household purchasing the average American amount of gasoline pays approximately $550 per year in federal and state gasoline excise taxes alone. Utility bills carry embedded taxes and regulatory costs that function as taxes, estimated at approximately 7 to 12% of the average utility bill by State Utility Commission analyses. When all consumption-side taxes and embedded costs are included, the average middle-class household pays an additional $4,000 to $5,000 per year in taxes they never add to their running total. Total tax load on a household earning $75,000, including federal income tax, state income tax, employee FICA, economic pass-through of employer FICA, property tax, sales tax, excise taxes, and embedded utility taxes, approximately $30,000 to $33,000 per year. An effective all-in tax rate of 40 to 44% of gross income. This is the number my accountant calculated for me on that April afternoon. This is the number that almost nobody knows because almost nobody has added it up. I am not sharing this number to make you angry about the tax system or to make a political argument about whether tax levels are appropriate. I am sharing it because if you do not know the full number, you cannot make informed decisions about how to reduce it. And the tax code contains significant, legal, accessible mechanisms for doing exactly that. Meet four people, all earning between $65,000 and $80,000 per year, all middle class by every standard definition, all filing tax returns every April and believing they are handling their tax situation responsibly. Their names are Tyler, Priya, Marcus, and Diane. Tyler earns $72,000 per year as a project manager. He takes the standard deduction, contributes nothing to a pre-tax retirement account, has a health insurance plan through his employer with a standard copay structure rather than a high-deductible plan, and invests any savings in a taxable brokerage account. Tyler is doing nothing wrong. Tyler is using the exact default financial structure that most American employers and financial institutions make available without any additional decisions required. Tyler pays approximately $16,800 in federal and state income taxes annually. He pays approximately $5,500 in FICA. He pays approximately $2,900 in property taxes. He pays approximately $2,600 in sales and consumption taxes. Total annual tax load, approximately $27,800, an effective all-in rate of approximately 38.6%. Tyler invests approximately $4,000 per year in a taxable account. He pays capital gains taxes when he sells and taxes on dividends each year even if he does not sell. He will retire with a tax liability on every dollar he withdraws from his taxable account. Tyler is not failing. Tyler is doing what the default system produces. Priya earns $68,000 per year as a registered nurse. She contributes 6% of her salary to her employer's 401k, enough to capture the full employer match, and has a standard employer health plan. She takes the standard deduction. Priya has captured the employer match, which is a guaranteed 100% return on her retirement contributions. She is doing one important thing better than Tyler. But Priya's 6% contribution, approximately $4,080 per year, while reducing her current taxable income, is invested in a traditional pre-tax 401k. Every dollar she withdraws in retirement will be taxed as ordinary income at whatever her income tax rate is in retirement. If Priya believes her income in retirement will be similar to or higher than her current income, which is increasingly common for middle-class Americans with substantial retirement savings, her traditional 401k contributions are being taxed at the same rate or higher than they would be taxed today. She has deferred the tax, but not reduced it. Priya is also not contributing to an HSA, not considering a Roth conversion strategy, and not aware that her current income level sits in a historically low federal tax bracket, meaning the traditional pre-tax contribution that feels like a tax advantage may actually be a tax disadvantage over the full 30-year horizon. Marcus earns $78,000 per year as a sales manager. He contributes 15% to his traditional 401k and earns approximately $4,000 per year in freelance consulting income that he reports as ordinary income on Schedule C. Marcus is saving aggressively. His retirement account is growing substantially. He feels well managed financially. But Marcus has $4,000 per year in self-employment income, on which he is paying both the employee and employer sides of FICA, approximately 15.3%, plus ordinary income tax. His total effective tax rate on that freelance income is approximately 41%. Marcus does not have a SEP IRA. He does not know that he can contribute up to 25% of his net self-employment income to a SEP IRA and deduct that contribution from his Schedule C, reducing both his income tax and his self-employment tax simultaneously. Marcus is also not tracking the home office deduction he may be entitled to, the professional development expenses, or the home office proportion of his utility bills that would be deductible against Schedule C income. He reports his consulting income as gross revenue. His actual net taxable self-employment income, properly calculated, would be significantly lower. Diane earns $65,000 per year as a graphic designer and has been with the same employer for 7 years. She contributes 8% to her traditional 401k, has not opened an HSA despite being enrolled in a high-deductible health plan for the past 3 years, and keeps her emergency fund in a standard savings account, earning less than 1% interest. Diane has been eligible to contribute to an HSA for 3 years and has contributed $0. The health savings account is the only triple tax advantaged account available in the American Tax Code. Contributions are pre-tax, reducing your taxable income. Growth inside the account is tax-free. Withdrawals for qualified medical expenses are tax-free. No other account in the American tax system offers all three of these advantages simultaneously. For 2024, the HSA contribution limit for individual coverage is $4,150. For family coverage, it is $8,300. If Diane had contributed the maximum to an HSA for each of the 3 years she has been enrolled in a high-deductible plan, she would have sheltered approximately $12,450 from federal and state income taxes. At her effective tax rate of approximately 24%, she would have paid approximately $2,988 less in income taxes over those 3 years. She would also have a $12,000 medical fund that grows tax-free and can be invested in index funds inside the HSA account, functioning as a secondary retirement account for medical expenses, which are among the largest costs retirees face. Diane did not miss the HSA because she was irresponsible. She missed it because when she enrolled in her high-deductible plan, HR gave her a benefits packet with 22 pages of information, and the HSA was on page 14. She checked the plan enrollment box, skipped the HSA enrollment step, and moved on with her day. She does not know what she has been leaving behind for 3 years. Now, I want to show you the specific decisions that moved my household's tax load from the 41% my accountant calculated to something significantly lower. Not through tax shelters or complicated strategies or anything that requires a specialist. Through 4 decisions that are available to every middle-class American and that collectively address the largest sources of preventable tax overpayment. Decision 1, choose the Roth versus traditional contribution based on your current tax bracket, not the default. The single most common middle-class tax mistake is contributing to a traditional pre-tax 401k when the Roth option would produce a better lifetime outcome. The conventional wisdom is contribute pre-tax when you are in a high bracket, pay tax now with Roth when you are in a low bracket. The current federal income tax brackets, the rates established by the Tax Cuts and Jobs Act, are historically low by American standards. The 22% bracket applies from approximately $47,000 to $101,000 of taxable income for single filers in 2024. The 24% bracket applies up to approximately $191,000. A household earning between $47,000 and $100,000 in taxable income is currently in a bracket that by historical standards is relatively low. The Tax Cuts and Jobs Act provisions are scheduled to expire after 2025, reverting to pre-2018 brackets that were higher at comparable income levels, though legislative outcomes are not certain. The person who pays 22% tax on Roth contributions today and grows that money tax-free for 30 years is often in a stronger position than the person who defers tax, grows the money, and pays at a higher rate on withdrawals. And most middle-class Americans are making this decision based on default enrollment rather than calculation. The first decision, run the calculation. Compare your current effective marginal rate against a realistic retirement income tax scenario. Make the Roth versus traditional choice consciously, rather than accepting the default. Decision 2. Open and max the HSA before any other non-employer matched investment. The investment priority sequence that produces the best after-tax outcome for most middle-class Americans is the following. Capture the full employer 401k match first. This is a 100% return before any other consideration. Then Max, the HSA, $4,150 individual or $8,300 family in 2024. Contribute the maximum. Invested in a low-cost index fund inside the HSA, and do not touch it for current medical expenses, if you can afford to pay those from other funds. The invested HSA functions as a supplemental retirement account for medical expenses. After age 65, you can withdraw HSA funds for any purpose and pay ordinary income tax, making it identical to a traditional IRA at that point. For medical expenses at any age, withdrawals are completely tax-free. After the HSA is maxed, max the Roth IRA at the current $7,000 annual limit. Then return to the 401k for additional contributions beyond the match. This sequence, employer match, HSA, Roth IRA, 401k beyond match, produces the highest after-tax retirement wealth for most middle-class Americans who qualify for all four vehicles. Most middle-class Americans do not follow this sequence because it was never shown to them. Decision 3. Capture every deduction available to any self-employment or freelance income. This decision applies specifically to the roughly 36% of American workers who earn any income outside a W-2, the freelance project, the consulting work, the side business, the rental income. Self-employment income is taxed at approximately 40% when you include both income tax and the full self-employment FICA rate. It is also the category of income with the most available legal deductions: the home office deduction, deductible business expenses, the self-employed health insurance deduction, and the ability to shelter substantial self-employment income in a SEP-IRA. The SEP-IRA allows contributions of up to 25% of net self-employment income, deducted directly from Schedule C. A person earning $15,000 in freelance income who contributes 25% to a SEP-IRA reduces their taxable self-employment income to $11,250, lowering both their income tax and self-employment tax simultaneously. The tax savings on that contribution at a combined rate of approximately 40%, approximately $1,500 per year, remaining in your net worth rather than going to the IRS. Decision 4. Understand your total tax picture as a number, not a rate. This is the decision that changed everything for me, and it is the least technical of the four. Most Americans think about their taxes in terms of effective rates and bracket percentages. The rate conversation produces a number, 22%, 24%, 31%, that feels abstract and incomparable to other financial decisions. The number conversation produces a different result. When you know that your all-in annual tax load, including every category of tax I described earlier, is $29,000 or $33,000 or $38,000, you can compare that number against the most significant financial decisions of your life. Is a $27,000 per year all-in tax load worth moving to a state with no income tax? You can now calculate that. Is the after-tax return on a Roth conversion this year positive, given your expected retirement tax rate? You can now calculate that. Is the tax advantage of maxing your HSA worth adjusting your health plan selection? You can now calculate that. Every significant financial decision has a tax component. The person who knows their all-in tax number can evaluate that component. The person who only knows their federal effective rate is working with approximately 40% of the information they need. The fourth decision: calculate your actual all-in annual tax number once per year, record it, and use it as the foundation of every significant financial decision you make. Now I want to give you the number that answers the most common question I receive about this topic. How much does this actually change in dollars for a typical middle-class household? Here is a realistic scenario. A household earning $75,000 per year, currently taking the standard deduction, with both earners enrolled in employer health plans with standard copay structures, contributing to traditional 401k plans, doing no self-employment income optimization, holding savings in taxable accounts. This is Tyler and a version of every middle-class household that accepts the default financial structure without modification. Annual federal and state income taxes with standard deduction, approximately $12,400. FICA employee contribution, approximately $5,700. Total visible income and payroll taxes, approximately $18,100. Now, the same household with 4 specific changes. 1. Shift from traditional to Roth 401k contributions, capturing no current year federal tax benefit, but positioning the portfolio for 30 years of tax-free growth and tax-free withdrawals. Current year tax impact, 0 to slightly positive depending on state. 2. Open HSAs for both earners, switching to high-deductible health plans where the premium savings plus employer HSA contribution make the switch net positive and contribute the family maximum of $8,300 per year. Current year federal and state income tax reduction, approximately $1,900 to $2,000 depending on state. 3. Track and deduct all eligible freelance income expenses. Contribute to a SEP IRA for self-employment income, and take the self-employed health insurance deduction where applicable. For a household with $10,000 of side income, this can reduce the tax on that income from approximately $4,000 to approximately $1,500. Annual tax reduction, approximately $2,500. 4. Restructure taxable savings into tax-advantaged accounts as contribution limits allow, reducing annual dividend and capital gains distributions taxed at ordinary income rates. Annual tax reduction, approximately $300 to $800 depending on investment mix. Immediate annual tax reduction from these 4 decisions, approximately $4,800 to $6,300 per year in current year taxes paid. But the larger number, the $18,000, is not the current year tax reduction. It is the total economic impact when you include the 30-year compounding difference between a Roth portfolio versus a traditional portfolio at the same contribution level. The compounding difference of an HSA invested in index funds versus the same money sitting in a taxable account, and the opportunity cost of each year of preventable tax overpayment that could have been invested in the mechanism that converts $500 per month into $1 million over 30 years. Each year of $5,000 tax reduction invested at 7% real return compounds to approximately $26,000 over 30 years. $18,000 per year is not an exaggeration. It is the realistic estimate of what the average middle-class household pays over a working lifetime in preventable tax costs and loss compounding from money that was taxed rather than sheltered, money that the tax code's accessible mechanisms exist specifically to address. I want to address one more thing before I close. The question I get asked most often about this topic is, do I need an accountant for this? For decisions 1 through 3, no. The Roth versus traditional calculation requires a simple comparison of your current marginal rate against your expected retirement marginal rate. 20 minutes with a free online calculator. The HSA enrollment decision requires checking whether your current health plan qualifies as a high-deductible plan and opening an HSA through your bank or employer's benefits portal. Approximately 15 minutes. The self-employment deduction tracking requires understanding which expenses are deductible and maintaining a simple record, available from IRS Publication 535 or any tax preparation software. For Decision 4, an accountant is useful for the first calculation. That is exactly what I used. But it is also achievable independently using your last 2 years of tax returns, your mortgage statement for property tax, your pay stubs for FICA withholding, and your credit card statements for an estimate of sales tax. The tools exist. The information is public. The mechanisms are accessible. What has been missing is the framing that makes it clear these decisions exist and what they are worth. My accountant told me nobody ever asks him how much total tax they are actually paying. 3 years ago, I was one of those people. I am not anymore. You have now seen the number that I saw on that April afternoon. You have seen where it comes from and what it is made of. You have seen the 4 decisions that address it directly. The only thing left is the decision to treat the number as real rather than abstract, and to make the specific changes that convert $18,000 per year from money that leaves your household into money that stays. Hit the like button right now if this video showed you a number about your own tax situation that you have never calculated before. It takes 1 second, and it puts this information in front of someone who has been paying the middle-class tax trap without knowing it has a name. Next, watch my video on the complete HSA investment strategy. I show exactly how to open an HSA, which funds to invest in, and the specific calculation that determines whether switching to a high-deductible plan is net positive for your situation before you make the change. And I want one answer from you in the comments right now. Did you know your all-in annual tax number before watching this video, including FITA, property tax, and sales tax? Or did you only know your federal effective rate? Because the gap between those two numbers is not just an accounting difference. That gap is where the $18,000 lives.